Hey, good morning, everyone. Marty Missouri here. It is Friday, the 2nd of September, 2022, with your weekly economic update, and I am going to include a quick stock market snapshot at the end. On your screen is the latest for our PWA General Conditions Index, and as you can see, we continue to deteriorate with a rounded down reading now to -7. So again, seems like every week that goes by, we get more firmly in a setup that we deem favoring recession odds over continued expansion odds going forward. Keep in mind, at least for the moment, our assessment of how bad this recession will ultimately get, if indeed we get one, is really not all that bad by historical standards. Our featured data points this week will start with the jobs number that came out this morning. 315,000 was pretty much right on the mark in terms of consensus expectations. The unemployment rate actually ticked up 2 points, or 0.2% to 3.7. On a monthly basis, average hourly earnings dropped 0.2%. The data that came out earlier in the week, from the job openings and labor turnover report, the quits rate continues to fall to 2.7. Now that's historically high, but it is falling. And again, folks, a high quits rate actually denotes strong economic conditions in a tight labor market. Folks don't typically quit their jobs unless they have something immediately better in the offing. 2.7 is still high, but the rate of change, or the direction, has been dropping. Job openings actually jumped up, surprisingly, to 11.3 million. Of course, that would suggest a tight labor market. However, this morning, I think the market likes the fact, along with a higher unemployment rate, lower average hourly earnings, rising participation rate. That's people coming in off the sidelines and saying they want to go to work. That would loosen up the jobs market, maybe put less pressure, less upward pressure on wages. And then the U6 unemployment rate, which includes discouraged workers, jumped up. I believe it was 0.2 or 0.3%. Market's liking that news. In fact, it's been all over the place this morning. It was up nicely at the start, came back down to almost even, but as I speak at you, the S&P is up 1.16%. So the market's reading this as a potentially disinflationary or a Fed-friendly, as it relates to the market, report. I think we should not lose sight of the fact that the Fed has been pretty adamant that they need to see a lot more for a lot longer in terms of headwinds against this high inflation before they begin to back off of the tightening pedal. And as I've been illustrating on the blog and quoting Fed governors and so on, they consistently are saying that the market just ain't getting it right or isn't taking them seriously. So be careful with letting the pigeons loose right here with regard to the market. Okay, moving on. Auto sales were off a little bit. That data came out officially this morning. We actually had it yesterday. So auto sales not looking really good right here in terms of what they say about the state of the economy. Mortgage purchase apps, we know that the real estate market is slowing markedly. Did have a pretty decent year-over-year increase in housing prices, but that really is highly likely to come off the boil if we look at the underlying factors that influence the market, or at least what's actually happening internally in the housing market currently. Consumer confidence, interesting. We actually got a slight tick up in both the conference boards and the latest from the University of Michigan. The weekly Langer study still is pretty much in the doldrums. Again, these are still really low confidence readings, particularly with the University of Michigan. However, we did see an uptick, and make no mistake, folks, that has a lot, if not everything, to do with falling gasoline prices of late. The ISM manufacturing survey came out this week. Services will come out probably Tuesday. Basically stayed the same at 52.8. Above 50 denotes expansionary conditions, so we don't have a recession reading just yet from the ISMs. Very encouraging is opening up in these supply bottlenecks. We're seeing it in the trucking industry. Prices are coming down quite notably. There are other areas of freight as well. Again, supplies are coming to some degree, and we've seen this in the retail space. We're seeing inventories maybe overreacting to that. So that could be somewhat problematic from a business standpoint, somewhat optimistic from an inflation standpoint. And then very interesting, inflation break-evens. This is the one we respect the most. These are CPI swap spreads, and let's just call these market inflation expectations. And you can see they're really coming off the boil. This would be the 2-year, the 5-year, and the 10-year read. We think these are overly optimistic. We think inflation is going to run hotter than that. And that actually is what's problematic for the market, if I'm right. The Fed is going to have to continue to be very tough to get inflation down to their 2% target if they're going to stick with that. And that's the thing that kind of could throw our soft landing, if you will, recession narrative into trouble, and it could essentially make for lower than right now our 3,500 price target on the S&P in terms of as bad as this gets. And again, those are all dynamic analyses, subject to change, and I touched on that already here earlier in the week, and we'll see if I go there here in a minute when we look at the stock market. Raw industrial prices, this actually scored a negative for us because they've really fallen off a cliff, right? So that, again, positive from an inflation standpoint, of course, just go back to March of last year, these are really high levels. Back then we would be freaking out. So, but it's it's the trajectory, it's the rate of change coming off the boil. That says not necessarily optimistic things about the state of the economy here currently. As I mentioned in the morning note, we remain very bullish. Copper, it's come off the boil here a little bit. We had a nice rally that I thought might actually pick up a little more steam. China is a huge factor there. This is just this week's news. Chengdu locks down 21 million residents, and Shenzhen this morning shuts down most public transportation. So when you get shutdowns of the Chinese economy, the biggest user of copper, you're going to see the copper price come down. Now, today it was announced that the 5-year get-together with the Chinese authorities, this one where they're going to appoint Xi to a third term, that's sometime in October. Where I really kind of missed the mark on this one is I thought that you would see Xi give up on these zero COVID policies and try to get the economy booming ahead of that important political event for him. Now, while they've been doing this, they've been really pumping on the local governments and saying, you guys need to get busy, you need to lend money, you need to stimulate. The amount of fiscal stimulus and monetary stimulus, I think, has been notable. Other people think it's been very weak relative to what needs to happen or what ultimately will happen. And of course, I mean, the people who we really respect say it's being allocated to the wrong places. China is just, always focusing on, top-down production type incentive, supply side stimulus, where they really have a consumption issue that they really need to, do more, direct to the consumer stimulus. That a lot of people think that's what would really help the Chinese economy. My view is, yeah, sure. Regardless, I'm looking at the reaction in terms of asset prices and commodity prices to what China does. And yesterday, a central bank official from China said that, we haven't really done that much monetary stimulus yet relative to what we can do, and implied that there's going to be a lot more of that coming. So to the extent that China impacts the price of copper, I think we get past this October meeting, and we may see changes in terms of how they treat things going forward. So that remains to be seen. The quote from this morning's note on copper, though, I think is just very, very, very telling. And what I featured there was, this was a tweet from a handle, GreekFire23. The Anglo-American CEO said we will need about 17 million metric tons of additional copper for the energy transition into EV and other sectors. That's like 60 more of their Quellaveco copper mines, and nobody has started any of those 20-year projects. And I know that for a fact. So capital expenditure expansion in the mining space is weak relative to what really needs to happen. And what does that do? It pushes the price of the metals up. We've got geopolitical problems in Latin America that we think weigh heavily in an upward fashion on the price of copper. And the miners look really good from a free cash flow standpoint, a valuation standpoint, and so forth. So the metals, the miners, yada yada, over the next several years look very opportune to us. Over the next several weeks and months, go ahead and flip a coin, like with a lot of things. And then lastly, for the kind of our macro assessment, the Baltic Dry Index, tracks shipping of dry bulk goods, indicator of the global economy, construction, expansion endeavors, and so on. And that's been falling off a cliff here of late, and you can see how that looks, going into recessions, right? So that is a negative indication. It's quite noisy, can be quite volatile. Positive with regard to, weaker inflation perhaps going forward, but, a net negative in terms of how we view it and how it reflects global economic activity, at least currently. And make no mistake, all that China news, the lockdowns and so forth, hugely impacts the BDI, the Baltic Dry Index. Let's just do a quick one. We'll just do the short-term charts, the daily and the hourly. So I wanted to start first here on the daily, and haven't shown you this in a while. This is the on balance volume indicator. It goes up when the market's up by the total volume that day. It goes down when the market's down by the total volume that day. As you can probably imagine, on a short-term basis, this can give you some really mixed or inaccurate signals. Longer term, I like to look at this one. So notice here, as the market was reaching our ultimate high that we had pegged, which was 4,300, the 200-day moving average, this downtrend line, etc. Week or two before we got there, this sucker was rolling over. So what that suggests is that you get this big volume on the down days, not even really big down days necessarily, and that denotes distribution. Let's just say, quote, the smart money was taking an opportunity to exit positions as the market was going up, and that's certainly what it looks like here, right? It was happening here to some degree as the market was consolidating right in there. Notice here, though, as the market was falling, look at below here, this was actually a bullish indicator, right? We hit lower lows on the index, right? But we stayed flat here. So that would have been bullish. Notice back here, late 2021, a big rollover as the market was hitting all-time highs. So this is a good one to look at, and we do look at it pretty consistently. Now, the ones I typically show you, the RSI and the MACD, we got way overbought. We had a sell signal right here. As I speak, really nice rally. Wow, S&P's up 1.25%. And back above 4,000. This is a delayed chart here. It's actually at 4,015. Really, really important, particularly when we look at how options dealers are positioned, that the S&P stay above 4,000. Our experts who consult us on this say the market is pretty solid from that perspective above 4,000, potentially really weak and dangerous below 4,000. So on a short-term basis, the close today, whether it's above or below 4,000, probably is meaningful. The fact that we are losing it here on the 50-day moving average, which is at 40.21, and we're just under that right now. As we continue, you can see here where we, came off of it, bumped its head against it, failed it, bumping its head against it again now. Probably also technically important that the market get above that 50-day moving average as well, at least for the bulls. And then on the short-term 60-minute, 60-day chart, remember on Wednesday, although the market ended up falling apart after we had that discussion, but then today we're rallying, but we had this falling wedge pattern and we had a bullish divergence on the RSI, and I said that was a bullish look. Started to break out of it, then failed. But what we did have is we had growing bullish divergence here on the MACD, then a buy signal right here as we broke out, and then continuing bullish divergence in an oversold look here on the RSI. So this makes a lot of sense. Nice gap today that we're experiencing today. So, even before the jobs number came out, the hourly chart was suggesting that the market was poised to rally. Then you break out of this downtrend line with some momentum, and you have something potentially meaningful. Again, I don't think I can stress enough the importance of that 4,000 mark. And remember, I said we could live there a few days, at least up till the jobs report. Well, we actually came below it, but it's almost like a vacuum. It's just kind of sucking everything back to there, and that has a lot to do, frankly, with all of this options action and where those puts and calls are positioned here currently. So, folks, interesting market, interesting economic setup. I just think lots of volatility. We're entering the worst season or the worst month of the year historically, which is September. So let's get through the Labor Day weekend, see what things look like next week. And I probably won't bother you again until next Tuesday. Hope you have a wonderful extended weekend. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.